By continuing to access this site, its content, or establishing any contact with Elliott Wave Live, you acknowledge having read and understand all disclaimers and risk disclosures. The following information described within this video or blog post contains information pertaining to hypothetical trades. These trades were not executed and are for educational or illustrative purposes only. Please read the CFTC Rule 4.41 that's on your screen, and keep in mind, by continuing to use this site, establishing any contact with its author, and or clicking on any of the links, you acknowledge having read and understand all the disclaimers and risk disclosures contained within my blog site. Hello everyone. Welcome to my free Global Gains mid-year forecast. I really appreciate you taking the time out of your day or night from wherever you are around the world. In today's call, you'll get to hear and watch me explain 20 market forecasts as well as the critical intermarket relationships that affect markets. You'll see the charts, the wave counts, and where I expect the market to turn. This presentation is for educational and informational purposes only. If you haven't reviewed the disclosures at the beginning of this video, please do so before continuing. My goal at Elliott Wave Live is to set myself apart from other educational Elliott Wave forecasters by providing you with unbiased, insightful analysis, keeping you abreast of possible turning points in the market, and teaching the nuances of Elliott Wave Principle. Others claim to teach Elliott Wave, but I'm the only one doing it in real time. Just by the way of an introduction, my name is Mike Sinibaldi, and I'll be moderating the call. I'd like everyone to know a bit about my story before we begin. I can trace my earliest interest in the stock market back to my childhood, where my grandfather was always buying dividend-paying stocks and spoke highly about his GM stock. That was in the 60s and early 70s. After graduating college and working as a microbiologist, I followed in my grandfather's footsteps and began investing in 1993. I followed the usual route for newbies: mutual funds, then stock, ETFs, and today I focus on a handful of global markets, primarily trading the E-mini S&Ps. I think that all the retail traders and investors on this call probably have some personal experience with the 2000 and 2007 bear raids. Furthermore, if you've been participating in this market for the last 10 years, you know that the buy and hold strategy that has been used successfully in the past is no longer working. The period is now dubbed as the lost decade, because investors who held tight throughout these market crashes have nothing to show but negative returns, and this is really bothersome to most long-term players. And that's why it's important to have a roadmap when you position trade or invest. You see, trading and investing is like driving your car to somewhere where you've never been. You don't know how to get there and will get lost unless you have a map or GPS. The Elliott Wave Principle is your GPS, and it works in any market or time frame for any type of trader or investor. There is no other forecasting method that allows you to gain an unfair advantage over counterparties. It provides the context for market analysis, the big picture of the market's current position, often identifying directional changes months, even years in advance. For those listeners who are new to the Wave Principle, can you see the value and benefit of knowing where the market may change direction in advance? It's like getting tomorrow's newspaper months earlier. Before I actually start showing you my forecast, everyone listening on this call needs to write this down, because it's rather a simple formula for successful position trading at the quarterly, monthly, weekly, and daily chart levels. While this webinar only relates to the first step of my formula, I think it's important for everyone on the call to know my formula for success. Once you know it, then it becomes so empowering in how you look at your trading. Here's my 4-step formula. Step 1. Know the larger degree trend. That's my twice-a-year global gains forecast, of which we're covering tonight. Step number 2, supplement your knowledge of the larger degree trend with my weekly Heard on the Street videos. Step number 3, become an expert at identifying corrective structures. Step number 4, become an expert at identifying which wave is the extended wave in an impulsive move. And without further ado, let's look at some charts where you'll discover where the next big move may occur and the value of higher time frame analysis using Elliott Wave. First, all the charts that appear in this presentation have been updated through August 12th of 2011. This recording takes several weeks to put together, and there has to be a cutoff date. I recommend that you reconcile all my forecasts with the most recent price action. Some of these forecasts will be amazingly accurate, while others will not be correct. That's the inherent nature and risk of long-term forecasting. First and foremost, I want to take a macro look at the markets. The S&P appears to be moving in concert with the CRB index. This comparison chart shows each equity market top 2000, 2007, and 2011. Each top in equities was followed by a top in the CRB index within 3 quarters. If the trend continues, expect further upside in commodities, but only through March of 2012. Also, the S&P downgrade of U.S. debt and its effects on the U.S. dollar are supportive for further commodity rallies. Keep this in mind during my review of the commodities markets later in this call. Here is a chart of the Dow-Gold ratio. Although I'm only using data dating back to 1974, the Dow-Gold ratio has followed a 35 to 40 year cycle dating back to the 20s. Each peak has been followed by a multi-year equity selling event and gold rallies. At the monthly chart level, the most recent peak occurred in September of 2009. And history appears to be repeating itself as gold is in a parabolic advance and equities are making a series of lower lows and lower highs. As you can see from the chart, wave 3 equals a 1.618 multiple of wave 1, a triangle fourth wave, and we're now working an extended fifth wave, 1, 2, 3, small fourth, moving to wave 5. Dropping to the weekly chart level, from wave 4 circle, the subdivisions count well. Prices reached a point where wave 4 circle divides the entire structure into two 50% sections at 6.14, yet the count appears incomplete. At the daily chart level, you'll see the same subdivisions beginning of wave 3. We have a triangle fourth, A, B, C, D, and E. And we've completed waves 1, 2, 3. I'm looking for a small wave 4 advance to maybe 691 on this chart, followed by another move to the downside that should test the 2.5 level. And here is a comparison chart of the S&P cash versus gold ratio. As you can see, the relationship is consistent with the Dow-Gold ratio and calls for a retest of the levels that were seen in the late 70s to early 80s. In conclusion, I suspect that equities will continue to underperform commodities over the next quarter. Equities, as you will shortly see, will remain in a larger supercycle degree secular bear market. Gold's outperformance will not end until the equity gold ratio, or Dow-Gold ratio, reaches levels consistent dating back to the late 70s or early 80s. The next set of markets that I'm going to look at are the U.S. markets. Here is a yearly chart of the Dow cash market. Notice that the wave 3 grand supercycle top is in, and we're currently working an ABC, expanded flat A, B, and C with a possible target of 570. 570 also corresponds to the previous fourth at the cycle degree level. And as absurd as this seems, it is possible. You only have to look at the gains from 1903 to 1929 and how they were obliterated in just 3 years. Dropping to the monthly chart level, we can see the subdivisions of Grand Supercycle Wave 4, where we have Wave A at the cycle degree level unfolded as an expanded flat, Wave A, B, C, for A zigzag for wave B, A, B, C, and wave C should come down to 51.4750, and I'm calculating that based upon a more classical approach where this pattern is a head and shoulder, left shoulder, head, right shoulder. Now typically the implications of a head and shoulder put the termination point or the target at a 1.618 multiple of this first leg, and that would be around 371. But for now, in the next quarter, I'm just going to focus on a move of equality and then reassess the market. And dropping to the weekly chart level, we can see the subdivisions of wave C of cycle wave B. And I apologize, this wave B should actually be over here, it's mislabeled. But we have waves 1, 2, extended wave 3, 1, 2, 3, 4, 5 for 3, wave 4, and a truncated fifth. The next market that I'm going to cover is the E-mini S&P. As you can see, we're working a very similar structure. We're in cycle wave C down, and dropping to the monthly chart level, you can see the subdivisions of cycle wave B, which is a triple zigzag, a W, X, Y, X, and Z triangle to complete cycle wave B. And finally, here is the weekly chart level, which should be familiar to all of my readers. So I'm not going to spend a lot of time on this, but this is our 2007-2011 analogy. And as you study this chart, you'll see several similarities that occurred between the 2007 top and the top that we just put in place at 1352.75. The next market that I'm going to cover is the NASDAQ 100. From cycle wave A, wave B unfolded in a flat correction, A, B, C, and ended just shy of a point where wave C equals wave A at 24.76. Price has broken structural support of 22.56. While I'm looking for a retest of 795.75, I remain cautiously bearish as the retracement of cycle wave A was extremely shallow and has only reached the 0.382 multiple. And as an alternate, I could label cycle wave B as wave A, looking for wave B down and then an impulsive move wave C back up. Either way, the forecast calls for a retest of 795.75. Dropping to the weekly chart level, I've broken down the subdivisions of each wave. From cycle wave B, notice that price has fallen hard during the last 3 weeks and has reached the 0.618 retracement level of intermediate wave 5. While we may see a small bounce, what I'm looking for is a 5-wave move to complete intermediate wave 1. Notice that the 2-4 trend line has been broken, clearly a bearish signal. And as a matter of further bearish confirmation, I'll be looking for a break of intermediate wave 4 to complete in less time than it took to build intermediate wave 5. By the way, intermediate wave 5 took approximately 1 year to build. So as long as wave 4 breaks within a year or less, the larger degree bearish trend remains intact. The next set of markets that I'm going to cover is the European markets, specifically Germany, the UK, and Italy. At the monthly chart level, the DAX is working cycle wave C to the downside, where waves 1 and 2 are complete. My previous edition of Global Gains anticipated this top. The subdivisions of wave 2 include an intervening triangle wave B, and where wave C equals a 6.8 multiple of wave A at 75.41. My longer term targets carry price below cycle wave A. However, from an intermediate standpoint, I've drawn a set of targets for you to review: 47.41 and 29.59. The UK or FTSE 100 index is working cycle wave C to the downside, where waves 1 and 2 are complete. This index resembles the US E-mini futures market, where wave 2 concluded in a triple zigzag that terminated at 60.49, just shy of the 0.786 retracement of wave 1 circle at 60.80.50. Prices have fallen hard during this month, and so far this is consistent with the third wave personality. My intermediate targets, not labeled, are 39.73 and 30.57. However, keep in mind that the most typical Fibonacci relationship for wave 3 is where wave 3 equals a 1.618 multiple of wave 1. that would place this market eventually at 614. The next market that I'm going to cover is the Italian market. Italy's wave structure is suspect as the bounce from the wave 1 low only reached the 0.382 retracement level, and has me wondering if this market is actually working a flat correction, where intermediate wave C will equal intermediate wave A at 12,625. Then the market will rotate back up in an impulsive manner to complete wave C circle of wave 2 circle that brackets the 50% retracement level of 28,125. I apologize, but 27,180 is incorrectly labeled for a termination point. Actual termination points represent a reverse Fibonacci of wave B that comes in at 27,365, slightly underneath the 0.5, and the 1.382 reverse Fibonacci retracement level of 29,140, which is slightly higher than a 50% retracement level. The next set of markets that I'm going to cover are the Asian markets, specifically Australia, China, and Taiwan. The Australian market is certainly interesting, whereas intermediate wave B is working a flat correction, where wave C will equal a 1.618 multiple of wave A at 3621. So I believe this market has one more move to the downside. However, this level is deep for a flat interpretation, and since intermediate wave A retraced 50% of the previous move, I've included an alternate count where intermediate wave A could be labeled as wave B, and therefore call for much further downside pressure. But for now, I'm sticking with the elongated flat interpretation that should terminate where wave C, that should be labeled wave C, not wave B at the intermediate chart level, should equal wave A at 55.46. The next market that I'm going to cover is the Shanghai Composite Index. At the monthly chart level, price is currently correcting the decline from 2007 to 2008 in what I believe to be a flat correction, where wave C red equals wave A at 2028 and intermediate wave B equals a 0.8 retracement of wave A at 2028. Flat corrections have a typical retracement level of 80 to 90% of the previous wave. This fits well with my interpretation of a flat correction. However, it is possible that a triangle wave B could be forming. If the flat correction plays out, after price hits 2028, I'll expect an impulsive wave C move that it should exceed high of wave A, but as I mentioned, there is a possibility that a triangle intermediate wave B could be forming, where this is possibly wave C. We'll have a 3-wave move, wave D, another 3-wave decline to complete wave E, and then move up impulsively. The next market that I'm going to cover is the Hang Seng Index. At the quarterly chart level, this market is in a multi-year triangle that should resolve to the upside. Currently, we're working wave E to the downside that should terminate at 16,060, the 618 retracement level of wave D. The final Asian market that I'm going to cover is the Taiwan Index. The index has completed a multi-year triangle at the cycle degree where wave E of wave 4 completed at 3951 and intermediate wave 1 completed in early 2011. Wave 2 down is underway, and I'm anticipating a termination point that closes the gap at the 618 retracement level of 5964. The next set of markets that I'm going to cover are the commodities markets. If you recall, earlier in this video I showed this chart where commodities peak 3 quarters after equities do. Let's see if the charts concur with this analogy. First, here's a chart of gold compared to the CRB index, copper, and crude. Notice that other than gold, each market is sideways to down. Is gold the last man standing? Does this indicate that only selective commodities have further upside potential while others are already in their decline? Any discussion on commodities should always begin with an analysis of the US dollar. as commodities are usually correlated negatively to the movement of the US dollar. At the quarterly chart level, we can see that I have wave Y of a corrective pattern ending where wave C equals a 0.618 multiple of wave A at 67.31, and we're currently working a flat correction, A, B, and this market should move up, forcing a decline in commodities. And at the weekly chart level, here's a closer look at the structure of the WXY corrective pattern for wave 2 circle. 3-wave decline in wave W, 3-wave advance in X, A, triangle B, C for wave Y of wave 2. Yet I must admit the dollar's wave pattern has eluded me for months. So let me offer another alternative wave count that you might be familiar with. Here's the same wave pattern blown up on the weekly chart level, WXY. But some of you might be trading what's called a butterfly pattern, and this pattern here would support the fact that commodities would rally for another 3 quarters, because this pattern forewarns that the dollar index will fall lower to new lows, possibly to either 67.67 or a 1.27 reverse extension of wave A to 65.85. To get a better feel for whether commodities have any upside potential remaining, and if the larger correlation between equities and commodities exists, we look at the CRB index for our first clue. In my opinion, the CRB index has completed grand supercycle wave 3 and is working a supercycle degree wave A that should unfold in 5 waves, where currently wave 1 and 2 are complete, and we're looking at a 3rd wave impulsive structure that should carry prices to where wave 3 is a 1.618 multiple of wave 1 that terminates at 556.35. Also, in doing so, the 2-4 trend line will be broken. Now, looking at the other side of the coin, the market has successfully tested cycle degree wave 3 and held. Until the 2-4 trend line is broken, I remain neutral to slightly bearish on commodities overall, realizing that what may be transpiring is the 3rd quarter lag and topping process that I spoke of earlier on this call. Opportunities are limited to the upside if this crest here is wave 3 circle purple, followed by a small 4th wave decline, then another move to the upside to complete wave 3 circle blue. And here's a chart of the DBA Power Shares Agricultural Fund, which also shows direction of commodities. Grand supercycle top is in, and we're currently working a large WXY pattern to complete supercycle degree A. The maximum target for this ETF is 1360. The next market that I'll cover is coffee at the quarterly chart level. Here, I believe, is one of those limited upside opportunities at the cycle degree level, where we're currently working intermediate wave 5 of wave 5 of wave 3 green. Notice wave 4 terminated, where wave C of wave 4 equals a 0.618 multiple of wave A. And here is the ETF of coffee, ticker symbol JO. Notice wave 4 unfolded in 3 waves, A, triangle B, C. Price should move impulsively here and terminate at a point where intermediate wave 5 equals a 0.618 multiple of waves 1 through 3 at 89.90. The next market that I'm going to take a look at is corn. At the quarterly chart level, from wave 3 circle, we have cycle wave A, wave B, and wave C should unfold impulsively to 111.6 to 184.4. That represents a 1.236 or 1.382 reverse Fibonacci extension of wave B. There is, however, one alternative wave count that I am considering, and that is that it's possibly an intermediate wave 3 that would be followed by a 4th wave decline, which we may be seeing right now, and then another pop to the upside to complete wave 5 of wave B. A break of 799.6 would confirm that the count shown on your screen is incorrect and that the alternate count would be applied. The next market that I'm going to cover is mini soybeans. Soybeans is on the verge of completed or has already completed a triangle intermediate wave 4 and should move impulsively to the upside to complete wave 5 at 1529. That will be followed by a precipitous decline to complete supercycle wave A. The final commodity market that I'm going to cover is wheat. Wheat is currently working a WXY pattern. However, the current structure of wave A purple is suspect, but the direction is not. Let me explain what I mean. I'm currently working what appears to be a leading diagonal. Waves 1, 2, wave 3 is smaller than wave 1, wave 4 should be smaller than wave 2, a final wave 5 to complete wave A. However, this could also be a series of 1, 2, 1, 2, which would be an even more bearish interpretation, or, since price is remaining within the corrective price channel, it's possible that this is nothing more than a corrective move that will be followed by the upside. What's important to take away from this is that although wave A is uncertain, the direction is not. Whether it's corrective or impulsive, the structure is not complete. The bottom line is, until otherwise noted, I'm looking down. The next set of markets that I'm going to cover are the currency markets. I've already covered the US dollar under the commodities section, so let's look at the euro-US dollar pair at the quarterly chart level. Currently, the euro has completed a WXY or simple ABC pattern and is currently working a three-wave decline or intermediate wave A, wave B, and I'm expecting wave C to unfold in an impulsive manner to where wave C equals wave A at 1.07. The next market that I'm going to cover is the dollar Swiss franc. The market appears to have made a spike low, which I'm considering wave 5 of cycle wave 5. If this interpretation is correct, two things are going to happen fairly quickly. One, we'll see an immediate challenge of the 2-4 trend line that should be broken, and it should do so in less time than it took to create or build wave 5. So look for a retracement back to the 1.2 level. The next market that I'm going to look at is the US dollar yen pair. At the quarterly chart level, the yen appears to be in a similar situation as the franc, where cycle degree wave 5 may be complete or may complete where wave 5 equals a 0.382 multiple of waves 1 through 3 measured from wave 4. Another possibility is that wave 1 of wave 5 is unfolding. While I find this highly unlikely, I at least want to put it out there because it would imply a total collapse of the US dollar. The final currency market that I'll cover is the Aussie dollar. At the monthly chart level, the Aussie dollar appears to have put in a grand supercycle wave 4 top that subdivides as follows. From grand supercycle wave 3 bottom, we have a supercycle wave A, B, and C, where wave C equals wave A at 110. Since the top, prices has fallen impulsively, and I expect the cycle wave 4 low at 97 will be challenged, as well as the 2-4 trend line that confirms the bearish implications of the bearish grand supercycle wave 4 top and the subsequent decline in wave 5 that should draw prices to below the wave 3 low. The next group of markets that we're going to talk about is the metal complex. Since the wave 4 low, gold has moved in a parabolic fashion in an extended fifth wave and may have topped. If so, prices should fall hard, which is typical of a terminal wave pattern, and eventually reach the previous fourth wave in a zigzag pattern. I'd like to draw your attention to the mini-sized gold contract at the quarterly chart level. Here, from the same wave 4 on the larger contract, we can see the subdivisions of wave 5 purple. where we have intermediate waves 1, 2, 3, and 4, and the extended fifth wave within an extended fifth wave, would terminate at a typical wave relationship where wave 5 equals a 1.618 multiple of waves 1 through 3. Also notice that intermediate wave 4 divides the entire wave 5 structure into two 50% portions at 1814. And dropping to the monthly chart level, we can see that wave 1 equals wave 3, and therefore wave 5 must be the extended wave. So this confirms my previous analysis at the quarterly chart level. And dropping one time frame lower at the weekly chart level, we can see the subdivisions of intermediate wave 4, where we have wave 1, 2, 3, 4, and we're working the extended wave 5 of 5 of 5. And finally, I'd like to share one of the technical pages with you at the weekly chart level. We can see that the rate of change has been declining, a momentum signature, as price has been rising. Also too, the relative strength index from intermediate wave 3 has been falling as price rises. What this tells us is that the wave count and structure of the gold market is very mature, so you need to be very cautious if you're long this market. The next market that I'm going to cover is silver. With limited data, I'm currently building this count, so there is a high probability that the count is incorrect. However, the direction will not be incorrect. To date, I'm working in A, B, C correction. That is completed, and we now have intermediate wave 1 and 2 complete. That should lead to a wave 3 decline to the previous fourth, which is near a 1.618 multiple of wave 1, a $16.36. The next market that I'm going to talk about is copper. Copper appears to have completed the grand supercycle wave 3 top, and I'm looking for a 5-wave decline to unfold at the cycle degree level to complete wave A. Dropping to the monthly chart level, we can see that price has reached the first level of support at 391 1/4. Support below this level comes in at 335.30 to 345.70. Due to the fact that I don't have at least a wave 2 to calculate further expansion series, this is all I can provide you with at this time. And dropping to the weekly chart level, you can see how I'm treating intermediate wave 5 of wave 5 of wave 5 as a truncated fifth. Price is challenging the 2-4 trend line, a bearish signature. Should price continue to fall, my final expectation is for price to fall to the 50 back level of 286.70, which corresponds to the previous fourth wave. The final markets that I'm going to cover are the energy complex. Here is a chart of crude oil at the monthly chart level, where the grand supercycle wave 3 top is completed, and we have wave A and B completed, looking for wave C at the cycle level down to complete wave A. Currently, price has reached 75.4, where the first two sections of wave C are equal, but I suspect that price will fall lower in the days and months ahead to 59.81 to complete wave 3 of a 5-wave sequence that completes cycle wave C. As most of you are aware, most of my work centers around the mini crude contract, and the following series of charts have been updated. You've seen them on my blog post or in my Heard on the Street videos, but I like to show them because it shows the big picture that I've been following for quite some time. Here at the monthly chart level, you see a very similar structure to the larger oil contract. We have wave A, B complete, working wave C down. We've reached the same 75.4 level. And one thing to note, that July was an inside bar, which forewarned of an expansion of volatility to come. And we certainly didn't get disappointed in August. And dropping to the weekly chart level, we can see that the AB trend line has been breached, and structural support at wave A is being challenged. Should price exceed wave A, we have confirmed wave overlap and most likely signals that the entire move is indeed corrective and will be fully retraced. And dropping to the daily chart level, we can see the subdivisions of wave C down. However, notice that I have an alternative count here. Should wave 4 red enter the territory of wave 1 red, then that would violate a major Elliott wave rule and would force me to reconsider the overall larger degree wave count and possibly adopt this alternative. Final market that I'm going to cover in this mid-year forecast is natural gas. I don't often show the yearly chart, but in this case I'm compelled to do so. Notice that natural gas appears to be forming a triangle, several inside bars. This is an explosive pattern waiting to happen. The question is will it resolve to the upside, or will natural gas plummet? Dropping to the quarterly chart level, I have the market working a W, X, Y pattern for supercycle wave A, which will be followed by a 3-wave advance to wave B. And finally, dropping to the monthly chart level, we can better see the subdivisions of the wave Y triangle. From wave E, we should see a 3-wave rally of supercycle wave B, but resistance along the way will be at $6.71 and $9.38. And by the time it's all said and done, I expect wave B to challenge wave X high of 1369. That pretty much concludes all the markets that I wanted to cover in tonight's webinar. I want to thank everyone, especially subscribers of my blog site and Twitter account, for attending. I know you're all very busy traders. If you have any questions or comments concerning the material, direct message me on Twitter, or you can comment directly to my blog site. I also want to thank the hundreds of traders and investors who stayed on the call to the end. I know your time is very valuable. For those of you who are not followers of my work, I'd like to share with you my website and my Twitter account information. I look forward to welcome you as new members and followers. Thank you so much, and as always, best of trading.